There we go. Okay, now we're recording. And I'll go back and show the agenda. We've got a few more join us here. I think I saw Carl join. Hello, Carl. How you doing?
Great, thanks.
So we did a part one of an options lesson last week, and I sent the link to the recording out to everyone that is an Anchorage IBD member. So those of you that are interested and missed the session, hopefully are able to watch the video tonight. We're going to just do a very quick review of part one and jump into part two. I had a lot of fun putting part two together, and Carl was gracious enough to help. We had a little discussion about part two a couple of days ago. So thanks for helping me with that, Carl.
Welcome.
Yeah. So I'd like to get started on time. So it's 7:01. So what I'd like to do is show the big picture.
I'm going to mute everybody but yourself.
Yeah, please mute yourself out there. Everyone just self-mute, please. On the big picture, which was recorded maybe a couple hours ago, says finally snapped a multi-day losing strength, which I was glad to see. Inflation data is coming up next. Costco, Lululemon fall on earnings. The stock market rebounded Thursday.
Right.
Stock market rebounded Thursday. NASDAQ Composite and S&P 500 snapped extended losing streaks. Costco Wholesale and Lululemon reported their quarter results after close, while key inflation data is due out on Friday. Yesterday, someone asked the question, will we ever see a bull market again? And I sort of chuckled when I saw that, because it does seem like it's been a long time since we've seen a really good solid uptrend, but those days are ahead of us. We just don't know when they're going to start. On seasonal effects, we're due for some positive days here. Usually there's something called the Santa Claus effect or Christmas rally, and December and January are relatively strong months. The big bull market that we had from March of 2009 until about a year ago, that started in March, and so that's only about 3 or 4 months ahead of us if that trend repeats itself. Notable action, IB stock Allegro Microsystems and leaderboard Dexcon are near buy points. Ahead of Thursday's open, the Labor Department said first-time unemployment claims rose slightly more than expected, which I think is supposed to be positive for the market. On Friday, before the market opens, wholesale inflation data is due. So I'm not going to read the whole thing, but my recommendation is that every day, just take the 5 minutes it would take to read the big picture. Sienna stock soared nearly 20%. I read this about an hour ago on this update. And then also look at the market pulse every day. We've been in a confirmed uptrend for quite a while now, at least a couple of weeks. The distribution count is a little higher than it was about 2 or 3 days ago, but still mid-level to slightly on the low side on distribution count. I would say the big picture tells a lot. Dexcom is into people that have diabetes. They make convenient devices. You see commercials on TV. They've sold a lot of those things. I think they just got approval to do a new or advanced version. The stock in September was $80 a share, and now it's $122. That's about a 50% increase in a very short period of time on Dexcom. Dexcom makes continuous glucose monitoring systems for diabetics, and the device maker recently won FDA approval for a new monitoring device. I'm just going to very briefly show the first part of today's video. I try to watch the video every day, and there's a feature, this little gear-looking wheel here. If you push the settings button, you can actually play it back at a faster speed. If you get used to it, it's not too annoying. So what I'm going to do is play it at 1.25. Did you hear that?
Yes.
Okay, you heard it. Okay, I'm going to put it in at 1.25. Let's go 1.25.
We're not hearing that.
So you're not hearing that?
No. The audio is not coming through.
Okay, let me stop sharing. When I go to share screen, I think there's a button. Oh, that button wasn't pushed. Okay, We'll start it over again. Sorry, that was my operator error. Here we go. I'll start it again.
Good afternoon, everyone, and welcome to Stock Market Today. It's Ali Cormick-Kentreep here with a breakdown of the action in today's session. We saw the NASDAQ take the lead on an up day and perhaps a nice change of pace to see a day where we had software and chip stocks leading.
Yes, indeed. Down 4 sessions in a row. We cracked that losing streak today. With chip stocks outperforming today, I think it makes sense to take a look at Lattice Semiconductor, ticker LSCC. Also take a look at homebuilder Lennar, which reports earnings next week. Ticker there is LEN. And finally, Agilent, a Hewlett-Packard spinoff way back in 1999, setting up in a good setup here.
Okay, those stocks coming up, but first let's take a look at the major indexes, kicking off with the NASDAQ, which led today up 1.1%, followed by the S&P 500, which had a gain of 0.3%. Also, the Dow up just shy of 0.6%. Small caps lagging here today with the Russell 2000 up 0.4%. So like you said, we had this 4-day losing streak. The NASDAQ kind of looking on the bubble, coming down to its 50-day line, undercutting its lows from November, testing its late October highs, and we did get a bit of a bounce. Of course, we're not out of the woods here, but this is definitely a level where we wanted to see the NASDAQ hold.
In recent weeks, the 50-day line has been a support level, so we didn't necessarily get a bounce with conviction off the 50-day line today. We're in this period where volume is light, but it looks like NASDAQ volume is going to come in pretty close to what we saw on Wednesday, which was below average. Good to see the NASDAQ find support here. Maybe looking a little oversold after 4 straight declines. But like you said, market's not out of the woods yet. We'll take today's gain and pretty positive action in stocks. But still definitely a challenged market here.
And so now it looks like the NASDAQ is right around that 21-day line. Hopefully it can get back above that level. Let's also see how the S&P 500 fared today from a technical perspective. It's right around that 21-day line after losing support at that level the last 2 sessions. Still has yet to get back above that round number at 4,000, which seems like an area we are looking at on the upside. On the downside, it does seem like the low from a couple days ago, right above 3,900, seems to be an area where, we get a lot of touches from both a support and resistance standpoint. It seems like a pretty narrow range of support and resistance levels that are taking shape here.
This was a 5-session losing streak that the S&P 500 broke today. Obviously, that 200-day line is a resistance level to watch. It got turned away there recently, and still a lot of worries out there among Wall Street investors about the state of corporate earnings, and if there is going to be a slowdown next year, how is that going to affect corporate earnings? And we've got that Fed meeting next week where we're going to get another interest rate hike. But was talking to Dave Chung just a little while ago that the odds for a 50 basis point hike are more pronounced, up around 80%. So 50 basis points in December, and then maybe another 25 or 50 in February. And that could be it for a little while. So, market is still trying to climb this wall of worry, but we were able to end the losing streaks today, so we'll take it.
We like drawing lots of lines in the sand, Ken. And with David Ryan, we were drawing a line across the lows. Perhaps this rate of ascent is too steep to ask to see if this rally continuing. We're still below that level as well. So I don't know, a lot of areas converging. It'll be interesting to see if we do break one way or another, or if we continue to see some chop and slop. And a lot of that does hinge on not only the rate hike expectations, but other economic data that comes out. Speaking of interest rates, let's just take a quick look at the 10-year yield, which we had an update in the market amid rising yields.
Well, it's what we said yesterday on this very video. I really think the market is at a point now where it wants to see that 10-year yield start to turn higher a little bit. But there's been so much buying in the bond market lately that's knocked that 10-year yield down from 4.33 all the way down to 3.5%. So bond market may be looking a little overbought here. The market was able to rally even though interest rates moved higher.
And we talked about the strength in tech. Let's get a visual representation of that with XLK, which tracks the technology sector of the S&P 500, up 1.6% today. So some nice outperformance here for the tech sector. And on the downside, XLE, which has been the standout group this year, reversing lower today by about 0.5%. So Ken, could we finally be seeing or be on the verge of seeing more of a significant rotation into technology and out of those leading commodity and energy related areas that have been so strong this year?
Probably too early to say, because when you look at the XLK chart, this looks challenged just like the major stock indexes at this point. So it's consolidating near its 21-day line, but you can still see that downward sloping 200-day moving average. This ETF is filled with a lot of large cap, mega cap tech names that have been knocked down mercilessly in recent months. So this one is technically challenged, but it was one of the best performing S&P 500 sectors today as the S&P rallied. So if you're thinking about maybe getting some tech exposure by looking at something like XLK, it's still a pretty risky buy underneath this 200-day moving average. So you could get a rally right up to that level and get turned away, which is what recently happened.
Well, let's take a look at
messed up the video there. This is something that you can watch every day. When you look at the big picture, the video is embedded near the top of the big picture. And when you look at the market sentiment to see if we're in a confirmed uptrend or if that a market outlook changes. And so hopefully you're taking advantage of that. And then some of us are subscribed to IBD Live and are watching that in the morning. I find IBD Live to be quite helpful. Start before the market opens and talk about market action for about the first hour and a half. Sometimes they'll bring up interesting stocks to watch or talk about what they've been selling or what they maybe are going to do an option play on. And frequently they have a guest speaker. So I find that to be quite interesting. So I want to do a quick poll, and I'm going to launch the poll. And we've done this one a couple of months now. And if you can see the poll, each person is allowed one response. So if you don't mind hitting the button for me and tell me where you are tonight so we can get a sense. And when we end the poll, I'll share that with you. We've got 80% participation. So if a couple more of you don't mind voting, please, and then we'll share. Okay, I'm going to end the poll here in 3 seconds. If you can see the results, I'm always blown away. Counting me, there's 3 from Alaska, 9 from the West Coast, 4 from the Central. It's after 11 o'clock for those guys out there. And then one person is way out there. Whoever's way out there, do you want to let us know where you're from? Okay, I guess they're going to remain anonymous here for us. So what I'd like to do is bring up Market Smith and briefly talk about leveraged ETFs, because I know a lot of you are quite interested in the topic. This is TQQ Daily. We'll bring up stochastics. On the daily chart, we had a crossover and a sell signal for those following the daily procedure on 12/5. Those of you that
Are you sharing the screen?
oh, sorry. Thank you for saying something. Can you see it now?
Yes.
If you're following daily all by itself and you don't mind doing a trade every 2 weeks or more, you got a very clear sell signal, looks like on 12/5. If you're following the daily/weekly signal, we do not have a sell signal yet. And so that if you've gone through the lessons, the daily weekly has a far fewer trades, and on a long-term basis over many years, performs almost as well as the daily only process. XL's had a good run lately, but it also had a daily sell signal around 12/5. It does not yet have a sell signal on the weekly. In fact, it surprises me on the weekly, the fast line is still almost going vertical. Let's look at
I have
FANs.
a question
Yes.
on SOXL. If China were to fight with the United States over Taiwan, how do you think that would play out affecting SOXL?
I don't know the answer to that one, George. I think anytime there is world events and maybe unpredictable outcomes, the market typically goes down. And usually when the market goes down, most everything goes down with it. I think it would be a shock to the world if China invaded Taiwan and whether or not the U.S. decides to intervene.
I figured because of Taiwan's semiconductor manufacturing, it would really hurt SOXL more than the market in general.
Probably, although I think military spending would go up and the military buys a lot of that type of equipment and chips. So sometimes, at least in my experience, when you think you know which direction the market is going to go and you decide to go long or go short, the market is confounding. Sometimes it does the opposite. If it was easy, everybody would be a multimillionaire too. It's something to be aware of. That's more on the fundamental side of what's happening out there in the world. Whereas technical analysis is, if you're a pure technical analyst, you ignore all that. All you do is look at what's on the screen right now and you focus only on the chart. So I think the main thing for George and all of you is if you're using sell indicators, in this case it's stochastics, some people may use moving averages or percentage or whatever. The main thing is if you're into any security, but especially if you're into the leveraged ETFs, make sure you have written down sell rules that you're actually going to follow so that if China invades Taiwan, and if in fact that does cause SOXL to drop, 20 or 30% in one day, you just automatically sell. You just get out of the way and sell it. So let's look at FAS.
Thank you.
Sure, my pleasure. So on FAS on the daily, they got a sell signal around 12.2, where the others were on 12.5. And the weekly, the fast line is turned down, but it hasn't crossed yet. So we don't have a sell signal on the weekly. If we look at TNA, TNA had a sell signal on the daily, also on 12.2. And on the weekly, we just see the very first bit of a downturn today for the first time in a long time, but not yet a sell signal. UPRO, it had a sell signal 12.2 also. The weekly hasn't even downturned yet. The reason I'm following the daily weekly is you seem to get, on a long-term basis, very decent performance, and maybe, like, I don't remember the percentage now, but maybe 1/4 or 1/5 or maybe even less trades than you do if you follow the daily. Now, if you're using a tool different than MarketSmith, MarketSmith is based on a 14 period time frame. So if you're on a daily chart, that's 14 days. If you're on a weekly chart, that's 14 weeks. With other software programs, you can change that to something different. You can make it a period of 10 or a period of 30 or 50. And so if you have a different trading platform and you want to try a different time period, I would recommend you do some serious back testing before you use real money. But if you're using MarketSmith, it's just slow stochastics with a 14-day period. One that is not quite as much volume, but one that tends to move quite a bit is Nail. To my surprise, I didn't see this until just now. Nail did a cross today and is right at a buy point on the daily, and on the weekly, almost up at about a steeper than a 45-degree angle. So Nail's got some interesting performance. Nail hit a low of 19.01 and it's 31.73. So that's a 67% increase since about mid-October. Housing is related to interest rates and et cetera. If you use Nail, just have your solid sale rules. There's another one called Retail that had a sell signal on 12.2. And on the weekly hasn't turned down yet. Does anyone have a leveraged ETF, either double or triple, that I haven't mentioned that you would like to see the graph on? Okay, hearing none. There's one that I have never traded, but I've been watching it, and that's yen. And yen is China bull times 3. Yen had a buy point on the daily on 11.29, and on the weekly, very, very strong uptrend on the weekly. So you see that the China stocks hit a bottom about 10.28 at a price of 19, and here it is at 49. So 49 divided by 19. So that's a 160% increase since 10.28. So I've never traded it. I don't recommend. I don't know enough about to recommend it. It has like 2.3 million shares a day. So it's tied directly into what happens over in China. So I think that's enough on the leveraged ETFs, unless anyone has any questions about using stochastics and leveraged. Okay, hearing none, I'm going to stop sharing. We have another poll. Where do you think the market is going to be in the next 60 days? Higher, lower, sideways? As if the market cares what we think. But let's just see what the sentiment is of some pretty smart investors, business daily type investors. So right now we have 60% participation, 70%, Let's get a couple more out there. 80%, 84% participation. I'm going to share 1, 2, 3. So you can see that 23% say higher, 45% lower, 32% sideways. We can see there's a wide split here with the bias heavily towards market lower in 60 days. So it's just an interesting data point for us there's 25 of us on the call right now. So what I'm going to do now is we're going to get into our lesson. I'm going to very briefly share some slides from options lesson 1, just as a quick review. And then we've got some really interesting slides for part 2. So let me share. So can you see options part 1? Thank you. We said there's only 2 types of options, calls and puts, and you can either buy them or sell them. If you're a buyer of calls, you have a right to buy. If you're a buyer of puts, you have a right to sell a stock at a certain price. If you're a seller of options, you have an obligation to sell the stock at a certain price on calls. With a put, you have an obligation to buy the stock at certain prices. It's extremely important. You only have calls and puts, and you can only buy them or sell them. So these 4 squares in this matrix tells the entire story. If you can get these down and understand them 100%, you're way ahead of a whole lot of other people. I developed this little option decision matrix. If you think the market or your security is going to go up, you could buy a call, or if you think the market is going up, you could sell a put. These 2 are fairly equivalent. If you think the market or your security is going down, you can buy a put or you can sell a call. What are the factors that determine the value? There's about 8 factors that determine the premium price of the stock option. Each option contract represents 100 shares of the security, whether it's an ETF or a stock. The Greeks are important to understand, especially delta and theta, but the others have importance also. Delta gives you an approximate probability that your option trade is going to work out successfully. Theta shows you what the time decay is, because all options have a limited life. Some options may only have a 1-year life, 1 week, 1 month, 1 year, 2 years, but all options have a decay called theta. And I listed 21 common option trade strategies, but there's more than 21. These are probably the most popular ones. These are the types of options that a lot of people trade. I probably trade 6 or 7 of these. There are some of these I've never traded and I don't want to trade. Some people find 2 or 3 they really like. Others don't mind trading a larger number of strategies. Then I showed you from an organization called Option Animal, maybe a 6 decision step process. What you should do before you ever even consider buying an option, including how you're going to get out of that with profit, or maybe if you're losing money, how do you exit it? And you do these 4 things before you ever place the trade. I showed you how to read an options table. The left-hand side of the table shows you calls. On the right-hand side are the puts. And you put those together. Here's a table. This one might be from Fidelity. The top half of the table is for options that expire December 16th. I put this together on 10/31. And the bottom half of the table are for options that expire on January 20th. And you can, for a popular stock like Apple, there's probably 20 different expiration months. I just happen to show 2 of them here. This lesson shows you how to read the table. I gave you an example on how to do a covered call on a dividend-paying stock like Chevron. On November 4th, Chevron was trading at $183.42 a share. You could sell a January 20 call and make $205 if you own 100 shares of Chevron, and at the same time you're collecting a dividend. There was a dividend that went ex-dividend, I think, on November 18th, and it's going to pay $142 for every 100 shares. Next week, that will be paid to all shareholders. So if you did this trade on January 20th, if Chevron, let me think about, if Chevron, let's see, the call strike was 210. So if Chevron was at 210 or higher, your shares are called away and you get $21,000. If Chevron is below, you get to keep your shares. Profit is showing a 16.38% if you went all the way out to March and sold the 210 call. If Chevron on March 17th is at 210 or higher, you get paid the $21,000. You get to keep the $475 premium that was paid for selling that call, and you collect 2 dividends. This shows the profit potential on the covered call strategy with Chevron. If on March 17th, Chevron is lower than $210, you get to keep all 100 shares, and you could sell another call option and do this again and again. And so I showed you in lesson 1 on January 28th, was a gap down in the price of Chevron. I'm going, what the heck is going on? They had a stellar earnings report. And so I bought 300 shares, cost me $38,715, and I still hold those shares. Chevron is paying a $5.68 dividend per year. If you hold it for the full year, it's going to pay you $1,704. I had sold calls. I had to buy some back because the price went up so high, and I collected dividends. So I showed you the real world example of the 300 shares that I bought at $129.05. On the day I put the slide together, my cost basis is $120.95 because I earned premium from options and dividends at the price of $183.42. I'm showing a profit of 51.65% in 9.5 months. And so that's just the example of how to do a covered call on stock that you own. It's like if you owned a house or an apartment and you rented it out to people and collected rent, but you maintained ownership of your apartment. That's sort of like selling options. Maybe a better example is if you rent someone an apartment on a basis of rent to own. If they rent the apartment for 12 months or 2 years, whatever the time frame is, that at the end of that time frame, if they want to buy the apartment, you fix the price of the apartment at the beginning of that contract. Back in 2017, Chevron only paid $1.08. 18, it paid $1.12, and on up to now, it's paying $1.42 a quarter. So Chevron is a company in the Dow Jones 30, and they tend to raise their dividends on a regular basis. But this is not my recommendation for you to go do covered calls on Chevron. This is for educational purposes only. I showed you how to do a long call option on Disney with multiple expiration dates. The strike price was 105 in all cases. So for example, if you thought Disney was going to eventually, say in a year and a half from now or something, was going to be substantially higher, if you bought the $105 option with an expiration date of January 19, 2024, that would cost you for 100 shares, one contract would cost you $2,000. And Disney would have to be at $125 just to break even. At the end of 444 days, if Disney was at 140, your profit is roughly $1,500. So that's just something that's one example of a long call. I'll show you how to do it on a leveraged ETF. This is TQQQ with a strike of $20. And I gave you all of these different months and contract lives. And so if you thought TQQ was going to go to $50 a share at the end of 444 days, if you paid $765, and if it goes to 50, your profit is $2,200. So that's just an example of how to do a long call. I think I got another one. Important trading considerations. They gave you 12 important trading considerations that you should think about before you ever consider trading options. You have to get approval from your broker before you can trade options, and I showed you how to do that. And my recommended beginning steps was apply for and receive option trading approval from your broker. Study one option strategy and get a full understanding of that strategy and how to set it up when you're making money and when you're losing money. Bite the bullet and do one contract. You can execute the trade and realize if it's a credit trade, your trade ticket is going to say you're selling to open. That would be like a bull put. Or you do buy to open, that'd be like a bull call. Carefully study how your trade behaves each and every day that it is open. Let's say you do a trade and the contract life is 20 days. During those 20 days, there's about 15 trading days. If you take the weekends out, you'll see what it does every day. If your option is working very well for you, and after the first 5 days, you've made 50% of maximum profit, you might want to consider closing it out and taking your profits, because you never know during a 20 or 30-day life. You never know when there will be news that could suddenly take a profitable option position to a negative position. After 5, 6, 7 days, if you can take 50, 60, 70% of the expected profit and put that in a bank, then you can go look for another trading opportunities. Always write down the lessons you learned in the trade journals. Be patient, it takes time. Then I showed you some resources for learning about options. I'm not going to go through every one of these. IBD's got a course, and I'm going to show you at the end of part 2. This course is on sale right now. It says limited time only, but this course is much cheaper today. And I also showed you a program that Options Animal has. So before I jump into part 2, any questions about what we just covered on part 1? Let me look at the chat and see if there's any questions there. It says, all leveraged ETF, did you create your own list or these in MarketSmith? Well, those slides that I showed you, Barry, those were MarketSmith slides, but I just put the symbols in myself. Those leveraged ETFs weren't chosen by MarketSmith, if that answers your question. I heard that U.S. and Taiwan will not allow China to take over. Hello from the East Coast and Las Vegas tonight. Okay, Tim, let's jump into part 2. I'm going to go to the presentation mode for part 2, and I hope you enjoy this one. Part 2 is for educational purposes only. All investments have risk. Funds can be lost. Options for experienced investors, and they can increase investment risk. They can also increase investment rewards. Tonight, I'm going to be featuring Chevron, and I'll show you 3 different option strategies for Chevron, but I want to be sure and tell you I am not recommending Chevron. I'm just using it as an educational purpose. We got the little cartoon. This is a guy like me sitting at the computer. It says, right now I'm working with a combination of charting techniques, Japanese candlesticks, Elliott waves, and a dash of magic 8-ball. I think this year we've needed a little bit of 8-ball. 2022 has been a pretty interesting year. Tonight, in those 21 strategies I showed you, the first example I'm going to give you is called a bull call spread. This allows you to enjoy profits if a security is going sideways, or especially if it goes higher, and it substantially minimizes your risk. 1,000 shares of Chevron is a whole lot of money. So the bull call spread is called a debit trade. And what the word debit trade means is you have to pay money to put these contracts on, and money is taken out of your account. The good news is whatever you pay for it, Let's say you pay $1,000 for a bull call spread. That is the most money you could ever lose. You can't lose more than that $1,000. You do not have to own any shares of Chevron or whichever stock you're trading. You don't have to own the stock to do the bull call spread. So you buy one call right here and you sell a call at a higher price. If you think that your security is going to go higher, if you're bullish on it, that's why you may want to do this. Your risk is very limited to whatever your premium is, but your reward is also limited because we're doing a spread trade. You're substantially reducing your risk. You're also limiting how much profit you can make. Let's just look at a graph of Chevron. I printed this out on 11/23. And you see Chevron's been trading in a channel since September. On a very short-term basis, it looks like there's support at 175. On a much longer-term basis, there's support at about 140. And on a longer-term basis, maybe around 130 something. IBD has us in a confirmed uptrend. We've been in a confirmed uptrend since November 10th. So we've been a confirmed uptrend for quite a while. So if you think Chevron, for whatever reason, or let's say you're trading a different stock, Microsoft, Apple, Nvidia, Merck, whatever it is, if you think the price action between now and the next earnings report, notice in Chevron's case, the earnings report is on January 28th. I'd like to find an option strategy that doesn't go over this date. Notice now on the good news side, when they reported earnings at the end of July, Chevron had a huge gap up because the earnings were up 240%. But there's always the risk that you can have a huge gap down. I'd like to do an option strategy that expires before January 28th. So I'm going to show you an example. This is a debit trade, so we only are talking about call options. So I'm going to look at a call option that expires on January 20th. And I want to take a rather conservative approach. I've got support at 175, so I'm going to buy a 165 call, and I'm going to sell a 170 call to create this chart pattern right here. There's a $5 spread. So if I were to buy 1,000 shares of Chevron, that cost me $184,000. But if I do 10 contracts, 10 contracts is the equivalent of 1,000 shares of Chevron in this case. So here's my 165 call that I'm going to buy. On that particular day, I could have potentially bought the 165 at $22.50. The most I would have had to pay was $22.65, but usually you can get a little bit better price. And the last time the 165 call traded at $21.90, and notice there are 10,500 contracts of the January 20 165 call. But to limit my risk, I'm going to sell the 170 call, and I'm assuming I can get $18.50 when I sell it. My delta is this trade is going to cost me $4 a share. So if I do 10 contracts, this bull call spread is going to cost $4,000. My maximum profit potential, because it's a $5 spread, if Chevron closes at 170 or higher, I make a $1,000 profit, which is a 25% profit in less than 2 months. And if Chevron went all the way down to 169, I would get my $4,000 back. Let's call my break-even price. So the maximum I can make is 25%. The stock can drop 7.6%. and I still make maximum profit. It can drop 8.2% and I would break even. So I call this sort of a conservative strategy because I pick strike prices well below that recent support, and Delta 0.78. Delta is predicting we have a 78% chance of making our $1,000 profit, our maximum profit. I think we have about an 82 or 83% chance of breaking even. If you could find a game in Las Vegas where you had a probability of making profit 78% of the time, there'd be a lot of billionaires walking around. Notice that when you're trading the bull call spread, you do not earn the dividend. That is not yours. You're synthetically playing with 1,000 shares of Chevron. I've got other slides to show you, but does anyone have a question about how we set up the bull call spread and why I'm showing that you have a potential of making 25% profit? Any questions at all? Okay. So I'm not going to get into great detail. I'm going to show you the exact same trade called a medium risk. All I did was move my strike prices up $5. So I take a little more risk on. Instead of having a 78% chance of making maximum profit, now I only have 71% of making maximum profit, but I'm going to make more money and I have less risk. So if this works out, I'll have a 30% profit in less than 2 months. I'm going to show you one that is, and this is how I got my prices right there. I'm going to show you one that I call medium plus risk, where I even move up $5 more. On the day I did my analysis, Chevron was trading at $184, and I showed the 175, 180 spread. So if Chevron closes at 180 or higher, you'd make 44% profit in 57 days, or 281% on an annual basis, but there's only a 63% probability that will work. I created a table for you to make it easy. I put in what I call the Floyd factor here that I don't think anyone else is doing. This table shows that for the bull call spread, we looked at a conservative, a medium, and a medium plus, and then an aggressive strategy. We showed what your maximum risk is for 10 contracts, controlling 1,000 shares, what your potential maximum profit is, and what that percent of profit is. And so if Chevron closed on January 20 at 185 or higher, that's a 67% profit, but you only have a 53% probability. This column shows the risk-reward ratio. If you spend $4,000 to make a $1,000 profit, the risk-reward ratio is 25%. That's probably about the least you would ever want to go for risk-reward ratio. The aggressive strategy, the risk-reward ratio is 67%. But notice what I did here. I took maximum profit times probability squared. And when you do that, you sort of put these on a comparable basis, and notice that on this comparable basis, 615 is the higher number of the two, but that's not all that much different than 608. I think I would be comfortable putting on this 165, 170 and going for 25% profit. Some of you may feel more aggressive and say, I think I could do maybe this one. This table helps you see the comparison between taking a conservative and aggressive approach. A 53% probability, that I'm not real comfortable with personally. Any questions? So the next trade we're going to look at is a credit trade. Some people only do credit trades. That's called the bull put spread. If you remember from this matrix I gave you, if you think a security is going to go up, you can either sell a put or buy a call. Bull put spread is like selling a put, but you limit your risk by buying. Your long put has a lower price. Your higher strike price is where you short it, and that's where you're going to make your money. You want the security price to always be higher than this number, and that's when you make maximum profit. If you wanted to buy 1,000 shares, that's a $184,000 investment. Earnings report for this particular stock, if we used a different stock, the earnings report would be on a different date. I'd like to have an option contract that expires before January 28. And so let's look at the January 20 put table. So my recent support is at 175. So for conservative trade, I buy the 160 put, which is right here, and I sell the 165 put. As long as Chevron stays at 165 or higher on January 20th, I make maximum profit. So let's see how this works. It's similar to the previous example. It's just that we're doing puts instead. So we are going to buy the 160 put. So it's going to cost me $1.50 a share. The most I would pay is $1.53. And I'm going to sell the 165. I'm assuming I'm going to earn about $2.10. The least I could earn was $2.07, but I'm trying to get a little tiny bit of extra money. So this shows that I'm going to make 60 cents for this spread trade, which means the most profit I can make on 10 contracts is $600, and I'm risking $4,400. But notice I have an 83% probability of this being successful, and I probably have about an 85, 86% that I would break even. And again, notice you don't earn the dividend, but if you were to do this credit trade, the bull put spread on November 23rd, you would only make $600. That's a 15% profit, which isn't too bad in 56 days. If we go to something that's has a little more risk to it, we can make $870 profit with a 77% profit. That's how we get our prices right there on the bull put spread. This is the 175, 180. Chevron would have to close at least at 180, which is $4 below what it was trading on the day I printed this graph out. Notice you can make 42% profit. You're going to make a $1,500 profit on a $3,500 investment. Your break-even price is at 173, which is about $11 lower than what it was trading on the day I put this table together. There's a 61% probability you'd make maximum profit and probably about a 63 or 64% that you would break even. I put a table together that summarizes all of my bull put spreads. So here's your risk on 10 contracts. And by the way, I'm giving 10 contracts as an example. Starting out, you might only do 1, 2, 3 contracts. I wouldn't do 10 contracts on my first trade. Here's the maximum profit you can make. Here's your profit percent, your probability of making that maximum profit, your risk reward ratio. 14% is a little bit on the low side. And if you use my factor where I take maximum profit times probability squared, it's suggesting that maybe this 170, 175, sort of like a risk adjusted, maybe the 516. Any questions about the bull put spread? We're only going to do one other example for you, so we can save questions to the end, but I'll stop now and see if there's any questions about the bull put spread. Okay, not hearing any. Now this one is a little bit complicated, so don't freak out when you first see it. not for a beginning trader, but it's called the Iron Condor. The only thing an Iron Condor is you're doing two spreads at the same time. You're doing a bull put, which I just showed you how to do. And at the same time, we're going to do a bear call. I'll describe what a bear call is to you. So we're going to do two spread trades simultaneously. So it looks like this. The left half is the bull put. On an Iron Condor, you're going to sell, you're going to buy a put at a lower price than the price that you sell your put. We're going to sell a call, and at a higher price, we're going to buy a call because we're doing that to limit our risk. If you were really brave and you didn't care about risk and you're looking to make some good money, you would do what's called a strangle. And on a strangle, you just sell. You sell the put and you sell the call, and you don't protect yourself with these long options. So notice we're going to buy and sell 4 different contracts. I like to do them with the same spread on each side. And you do this if you think that the security is range bound or neutral, or it's going to go up just a little bit or down a little bit, but it's not going to make any giant move. Your risk is limited. Your reward is limited. The reason I like Iron Condors, I don't trade them really frequently, but the reason I like them is you earn 2 premiums. You earn the bull put premium that you get to keep. You earn the bull call premium that you get to keep. And if the stock stays between these 2 points, you make total maximum profit. And you can only lose money on one side. If you start losing money, the stock is either going to drop below this price or the stock's going to drop below this price. And again, this is a low-cost way. If we do 10 contracts, it's a low-cost way to control options on a equivalent of 1,000 shares, which if you bought 1,000 shares, that'd be $184,000. So I'm going to show you a conservative Iron Condor strategy. Now, the reason these have a $10 spread is you notice on the options table, you have all these $5 spreads, but when you get up here in this range, when we hit $200, the option contracts come in $10 increments. And because I want to use the same spread on both sides, I do a $10 increment on both sides. My conservative strategy is I want Chevron to stay between 160 and 210. So it can drop $24. It can go up $26. If it stays in that range between now and January 20th, I make total profit. How do we set it up? Okay, for the put side, I'm going to buy the 150, and it's going to cost me 70 cents a share. The most I would have to pay is 72. So you see, I shaved it off just a little bit. I'm going to sell the 160 and I assume I can earn $1.45. The least amount of money I would have earned that day is $1.41. On the call side, I'm going to buy the 210. I'm going to sell the 220. So I make $1.25 on this Iron Condor. But because it's a $10 spread, I'm risking $8,750. My maximum profit is $1,250, and that is if Chevron stays between 160 and 210. My break-even price is 158.75 to 11.75. And I make a 14% profit or 91% on an annual basis. The stock can drop or rise 13 to 14%, and I still make maximum profit. If it drops 14% or rises 15%, I break even. And I have a 79% probability of success. And let me show you how we calculate that. On the short put, our delta is 0.12. So that says I have an 88% chance that Chevron will be at 160 or higher. Right here's my 88%. On the call side, I showed 90. I guess I really should have showed 89, but I showed 90% probability that it would be at 210 or lower. So you multiply the probabilities together, because now I can lose money in two different directions instead of one. When you multiply those two numbers together, you get 79%. I do not own the dividend. I'll go straight to the table. The conservative spread, Chevron had to stay between 160 and 210. On the medium risk strategy, has to stay between 170 and 200. And on my aggressive strategy, stays between 175 and 195. But notice on this aggressive strategy, I'm only risking $2,600 to make $2,400. But I only have a 48% probability. So when you go to my table that I've developed out of my own engineering intuition, you'll notice that this medium profit times probability squared stands head and shoulders above the other two. In fact, the aggressive strategy has the least value to me. So if I was going to do an Iron Condor that expired on January 20th, I would either do the conservative or the medium. And what you can do when you're doing option contracts, the cool thing about them is, let's say that in 10 or 15 days, you've made 50% of the maximum profit. Just close it out and take the money home. Or after 15 or 20 days, you say, wow, I'm not going to make a profit. I'm already losing about $300 or $400. You might just close it out and say, okay, this isn't working. And what you can do, and what I have done more than once, let's say that I've got an Iron Condor that looks like this, and the price, let's say the price starts dropping. Maybe it gets down here to like 180, and all of a sudden it looks like I might be losing money. I may just close out the puts and let these babies ride, because these babies are going to make money for me. And so there's some different strategies you can use. I don't expect, if no one has traded options, I do not expect you to fully understand the Iron Condor, and I certainly don't expect you would trade it, but I'm just exposing you to some of the language about option spreads. We've shown you 3 different spread methods tonight. And I mentioned to you last month that IBD has an option trading course. It was $897. And I noticed today it's $499. It says for a limited time only. I don't know what that means, but that's not a bad price. If you're interested in that, just call up IBD and say, hey, I see you got your options trading bundles on sale for $499. The only thing I don't like about the IBD option program is when you pay for it, you only have access to the lesson for 3 years, and then it expires. And so if 4 years from now you want to go back and refresh yourself on one of the lessons, they're not going to be there. I'm not sure why IBD does that, but just full disclosure. I called the guys up at Options Animal and I said, hey, I'm doing a part 2. I said, can you give me a better deal? You had 35% off last time. Through December 16th, they have a 40% off. You can get an absolute free consultation. You don't have to give them any money at all. They will talk to you about your experience, what you're looking to do, if you've traded options before. And they'll give you 2 years of free premium services. I hope at least 1 or 2 of you would call this phone number and check out the program if you have any interest in options at all, and ask them what they have to offer for you. I took 60 or 70 of their lessons and learned a tremendous amount. So I guess I'm going to open it up now and say, what questions do you have? We have plenty of time for questions. And I can look at the chat and see if there's any chat questions down here that we need to address. I don't see any new ones. Ask away, because we're done with our lesson here.
I have a question on part 1, the TQQQ option.
Yes, we'll go to that. Excuse me, I'm trying to get back. Let me do it this way. I think if I hit escape, let's go to right there. There it is. Okay, George.
If you could show that chart that you showed with TQQQ, there you go. Could you go over that one more time real quickly?
Okay, so the different colored lines are the expiration date or the duration of the contract. The orange line, this was done maybe like November 1st. So expires on November 18th. So when I made this table, there was only 17 days left. And it was going to cost you $193. Your break-even point right here was $21.93. If on November 18, TQQ was at $21.93 or lower, you lost all $193. If TQQ was at $25, you would make about maybe $300 profit. If it was at 30, you would make maybe $600 profit. And so these days in this column are the duration of the contract, the dark blue line being 444 days, expires January 2024. It's going to cost you $765. Your break-even point when you put this on around November 1st was $27.65. But if in 444 days, if the market takes off and TQQ is at 50, your $765 investment will pay about $2,200. And so you end up with about $1,500 profit. So does that help you understand these colored lines, George?
Yes, $1,500 per contract.
Per contract. Yeah, these are costs per contract. And so if you put on 10 contracts, that would cost you $7,650, but then you would make $15,000 profit if TQQ was at 50.
Okay, gotcha. Thank you.
Anybody else for questions? This was so clear, I don't have a question, or I don't know what you were talking about. So it could be 50-50 here, but there's no crazy questions.
I have a question.
Go ahead. Yes.
Does anyone know of any good spread scanners that will scan 1,000 spreads, do those calculations, and show the probability and payouts?
That's the question for the group because I don't know a scanner. Anyone know?
Insight Think or Swim has a feature, but I didn't use it.
I'm sure there are scanners out there. I guess I would say if you're going to use one, just make sure you 100% totally understand it and have a good appreciation for the risk reward ratio, et cetera, which I'm sure you would. It may open up some interesting possibilities. The one caution I would have is if you see something that looks almost too good to be true, it probably is too good to be true. It might be on a security that has very low trading volume and the bid-ask spread might be sky high. So if you have a security that doesn't trade a lot of options, sometimes the bid-ask spread is 10 or 15% from the bid to the ask. And so if you see something with a very large bid spread, you know what I'm talking about, Jay?
Yeah, of course.
If you see a big spread, stay away from it.
Yeah, it could have earnings coming up, so it elevated the volatility.
Exactly. Just be aware if you see one that looks like it's really hot, just be sure you know what you're dealing with. I like to go for big cap stocks that have a lot of option trades and also a stock that isn't extremely volatile and gaps up and gaps down every other day. But I'm more of a conservative kind of guy. There may be other people that love that kind of action and can figure out a way to make a profit. So part of what you need to understand before you get into options is you need to have a pretty good understanding of your own personality, your strengths, your weaknesses, your tolerance for risk. And you may not know until it actually happens to you, but if you put an option contract on and you believe you're going to make $7,000 profit and something happens, there's an announcement that the CEO is retiring or CFOs being charged with a crime or a drug that they were testing failed the test. You may go from thinking you're going to make a $5,000-$6,000 profit to suddenly you're looking on day 3, 5, 7, 10. You're looking at maybe a $4,000 or $5,000 loss. And until you actually see that happen to you, you may not know how you would respond. You may not know what your whole psyche is going to do and what your emotions are going to be. If you remember this graph, let me go back and find it. If you remember this graph right here, this 6-step options animal strategy, I learned it from these guys when I took their classes. And it took me about 3 years to go through their program, by the way. I took about 70 or 80 of their classes. One of the most important items is step number 4 before you ever place the trade. Your primary exit is an exit when you're making money. If your goal is to make $5,000, is your primary exit to close it out when you've made half of that or made 75% of that? Or are you going to go for the gold and wait for the entire time? But if you have an option that has 60 days life, if you've made 60% profit in the first 20 days, I would take it and run with it. The secondary exit is, what am I going to do if I start losing money? Am I going to let it go down 5%, 10%, 20%? So you need to write these down or print a graph out and use red ink. Say, I'm going to get out on the good side here. But if this thing turns south on me, let's say my goal is to make $5,000 profit. I may say, if I'm negative $2,500, half of my expected profit, I'm going to close the position no matter what. Write all this stuff down so that when that starts happening to you, and believe me, it will happen. If you trade 100 contracts, 70, 80, 90% of them might work out great, but some of them are going to lose money. When that happens, the emotions start kicking in. If you've done step 4, you know exactly what to do. Okay, what's the next question?
Floyd, it's Carl. Let's go back to the Iron Condor.
Yep.
And you created something in here that I hadn't ever seen in the books before, but I thought it was very intuitive to you. You worked the overall probability instead of just the probability with each leg to analyze.
That, if you go to any probability calculator, I can show you an example. If you go to Tastyworks and put these exact strike prices in, when Chevron was trading at whatever price it was, $184, and there was 50 something days left, they would show you that your probability is around 48% because they multiply the probability of the put times the probability of the call. The reason they do that, and the options guys explained this to me, is when you put on a spread trade, like a bull put, bull call, bear call, you can only lose money in one direction. With an Iron Condor, you can lose money if it goes up. You can lose money as it goes down. So the smart guys have determined you multiply this to get the overall probability of success. Does that answer it, Carl?
Yeah, I just thought your audience ought to go ahead and see that because I hadn't ever seen it in some of the textbooks on it.
If you go to any trading platform that has a probability calculator, when you do an Iron Condor, the number may not be exactly the same thing I have because they may have other formulas, but it will be a much lower number than the individual probability. And that's true of a straddle or a strangle or anything that can lose money, whether it goes up or down. Thanks for asking that question, Carl, in case that wasn't clear to somebody. Even though this looks like it has a very high probability of success, like this 30 means you have a 70% chance of success, and this 32 means you have a 68% chance. Your probability of success is only 48 because you can lose in both directions. I do what I call Floyd's chicken trades. If I was going to do an Iron Condor, I probably would do one like this, where I have almost a 90% on both sides, and 90 times 90 is 81. I like to do chicken trades because I don't want to have to wake up in the middle of the night wondering what my Iron Condor is doing. When I have a combined probability of success of 80%, I'm smiling and I don't mind putting that on. If someone thinks it's funny that I call myself a chicken trader, I don't care. I like to control my risk and increase my probability. And if I have a high probability of making $1,000, I'm much happier and much more calm in my demeanor of trying to make $3,000 and only 30% chance of success, say, for example. That's why, let me go back to a slide. That's why in lesson number 1, you might want to review this. In lesson number 1, important trading considerations. There's 12 considerations here that I'm not going to read now, but you might want to study these. For example, how do you calculate the break-even point, the maximum risk, the maximum profit? What are the Greeks telling me? If I need to roll a position, what does that mean and how do I do it? Understand the impact of each trade on your buying power. You may find 5 wonderful trades you would like to do, and you start putting trades on. When you put the 4th trade on, your broker might say, no, I'm not going to allow you to do it. You ran out of buying power. So you need to understand, because the broker wants to protect themselves and assume you're going to lose money. They take money away from what's called buying power. So you need to understand that, understand assignment and exercise. So these are 12 important things to, not trying to scare you guys. And so what I did is I came up with first steps to do. I came up with 7 first steps here, which sort of incorporate those previous 12. There's 22 participants right now. I don't know if half of the participants have traded options or only 4 or 5 of us, but it's just another tool in the toolbox of ways to make money and ways to lose money in the market. If you use some wisdom, like I love the covered call. I've been doing covered calls for 25 years. And if you have a stock that pays a dividend, and it's a fairly stable stock, I like to sell calls that earn me as much or more than the dividend without getting my stock called away. And it's like getting 2 dividends. So if I own 1,000 shares of Apple and I sell 10 contracts, instead of getting 10 dividends, I get 20 dividends. And so there are some lower risk strategies than other strategies, and covered calls are, the IRS even allows you to do covered calls in an IRA account. Whereas some, I don't know if you can do an Iron Condor in an IRA. You might be able to, but I'm sure you can't do straddles and strangles in an IRA. Any other questions? So I guess I just would like a little feedback. You can either unmute yourself and tell me, or you can put in the chat window, was this informative and useful to you? Any comments or feedback? Was it understandable and helpful?
It was very,
Go ahead.
it was very useful. But I don't know what I'm going to be doing an Iron Condors.
That's fine. I mean, but at least now, when you hear the word Iron Condor for the rest of your life, you will have a picture of that trade. Remember the guy, when I was on options animal class, the guy called it a pilgrim hat, that shape of that graph. I'll show you what I mean on the Iron Condor. This guy right here that the guy called the pilgrim hat, that shape shows you your profit and loss curve by putting on 4 different types of contracts, calls and puts. So at least George, in the future, if you hear the word Iron Condor, it won't go over your head. You'll go, oh yeah, that's a crazy thing Floyd talked about.
Yes, true.
But I hope it was helpful.
Yes, I always learn.
Okay. Anybody else? Okay. Our next, I think it's January 12th is our next meetup. This meeting is being recorded, so I'll send a link out no later than Saturday. So people that missed the presentation, or if you want to go over it again, the link will be there. You know my email address, tqqqinvestor@gmail.com. If you think of a question in the future or didn't want to ask a question or not, don't hesitate to send me an email. Oh, poor man's covered call. Okay, hey, David, I want you to describe a poor man's covered call. Tell us what that is. You there? Did David already sign out? A poor man's covered call, if I remember correctly, is a covered call when you don't actually own the stock.
I think he typed it in a long leap at 85 delta and then selling weeklies.
Long leap, 85. So the 85 delta means 85% chance of success. And then he's doing weekly short options at the money. So he doesn't own the stock. The short options at the money is sort of like the equivalent of owning stock, and the leaps out 85% chance of success. And so what you do is you keep every week you sell these short options. And if this works out well, it can generate a lot of income.
Comparing this, when you go rent a car to Hertz, they try to sell you daily insurance at $19. So just think that they buy the annual insurance policy and then sell it by the day. It's similar to that.
Excellent example. So they're making a ton of money on that daily insurance premium.
On this PMCC, or it's pretty much a fancy name for a diagonal. This is just a diagonal spread. You want to look at the volatility of the front close weekly option or monthly, whatever you use, is higher than the long dated, because then you're selling at a higher premium than you're buying at.
And is this Dave talking?
No. This is Jay. I don't think he has a
Jay.
mic. He's never.
So Jay, does this work better for large cap stable companies and high tech companies, or is there a type of stock where you have found that the poor man's covered call works better, or does it just depend?
I don't think there's a type. What you want to look at is your overall delta. And I would say look at your break-even points.
Okay.
Which a lot of people don't do that. But, know your break-even and where am I now? And at expiration, what's my break-even point? And look at the graph into the future. And I don't do these myself. I do Iron Condors. I do strangles because I wanted to go even wider. So I'm even more chicken than you. I'm in the 95 to 98% because I want to sleep at night.
Yes.
And
yes.
And he typed some new stuff. He has one on Microsoft.
Oh, Microsoft and Procter and Gamble. Okay. Okay, cool. Thank you. Thank you for sharing that. Both of you, Jay and Dave, thank you for sharing that. And I'm glad to hear there's other chickens out there.
These educators stress the risk reward. I'll quote unquote risk more. I'll put up more money if it means a much higher probability.
So Jay, do you have a rule if something's going against you, do you close fast or do you let it ride a little bit? Or do you roll?
Actually, I've developed a system where I don't close because of a loss or because of a gain. I will reposition to my ideal trade as if I had no position at this time. Does that make sense? So I will close the trade and now I have a clean slate and okay, where do I want to be? The rolling mentality, always roll for a credit, can back you into a corner if it goes against you and I have to roll for a specific cash flow credit. It can put me in a riskier trade and I have to do it again and end up in a trade that you don't want.
My experience has been if you're going to roll, only roll once, never roll twice.
So, what I do instead of, I used to do the 50% profit target and all that. Now it's just based on my next trade. And I just put the next trade on and close it. Whatever the profit is, it is what it is. If it's 40%, if it's 70%, I look at the probability of profit. And if it gets below my comfort point, let's say 93% probability, I like to be 95 to 98. If it gets to like 90 to 93, I may want to be out. So, and just reposition it to a different strike.
Okay. Thank you for sharing that. I really appreciate that. Any other comments out there? I'm about ready to sign off. I've had a tough week. We've had some personal family challenges and I'm sort of running out of gas here, but I'm open to if anyone has a question they'd really like to ask, we have time for that.
What's the subject of the next meeting?
I do not know. What would you like it to be? I've gone through a little bit of family trauma here, unfortunately. Not me personally, but in Alaska, we've had some family trauma and I've been a little bit out of sorts. And so I haven't sat down and thought about January just yet, but I need to start thinking about that. And I will announce what the subject is before the 12th of January. I don't feel like it's, and you guys give me feedback here. I don't feel like we need a part 3 on options. I think part 1 and part 2 introduction is enough. And if someone really wants to get into options, that's really not an IBD thing. In fact, when Bill O'Neill was active, they hardly ever talked about options. If someone really wants to get heavy into options, you're probably going to do it in a program that's separate from IBD, like an options animal or Tasty Works or someone else. And so unless I hear anyone saying there's a compelling reason to do a part 3, I do not plan on doing that. Anyone want to give me feedback on that? Do you feel like part 1 and part 2 was enough?
Yeah, I think that was enough. William O'Neill rarely used options. I asked Mike Webster and Charles Harris, and they said they could only think of one time he used options, and that was because he wanted to own so much of that particular stock. And IBD has always shied away from options.
I went to a seminar in Dallas, and I think it was the last time Bill O'Neill spoke publicly. And it's the main reason I went to Dallas, because I had a sense that maybe he was about over. I asked Charles Harris, Mike Webster, or one of those guys, hey, I'm an IBD meetup leader. Develop a module on options for me. And they put their finger up to their lips and said, shh, don't mention that word right now. Let's wait until Bill retires, and then we'll start rolling out options. And they did. They waited until Bill went away, and now they have that course on sale. But I don't feel like for a meetup leader that I should go into greater depth on options, but I guess I would like feedback to see if anyone feels differently about that. Feel free to unmute yourself and comment if you want.
If someone just wants to get more info, Tasty's website has plenty of videos and introductory courses.
Oh, they probably have more than 200 or 300 videos.
If you look for their course, that kind of just breaks down the beginning phases. So that's a way to
Right.
look at it without putting money into it.
The only thing about Tom Sovsnoff and Tasty Trade is I went through quite a few of their videos. They take more risk than I'm willing to take.
Yeah, absolutely. Yeah, that's
Yeah.
they're at one expected move. I'm at 3 expected moves. Yeah. So yeah, I agree. But
They do explain a bull put, a bear call, Iron Condor. They have videos that explain those. If you're not careful, it's sort of like these kids these days that get on social media. If you're not careful, you get on Tasty Trade.
I just saw your message about the Anchorage Ponzi scheme. What's that about? What happened there?
There was a guy that was 29 years old. He set up an investing business, attracted a large number of people, and absconded. They don't know where he is right now. He absconded with $7 or $8 million, and the state of Alaska is looking for him. And he's subject to having to return the $7 million and about a $1 or $2 million fine. And I think he's grabbed the money and left Alaska. And there's all kinds of crazy people that were giving this young guy money, and he was producing false showing
Statements.
that people were making money. He was doing a Bernie Madoff thing where he was creating statements to people, and he was just using other people's money to fund his lifestyle or something. And so it's just incredible that people would give someone like that money. But I think he promised them that with him, they wouldn't lose money.
And maybe offering a specific return.
A friend of mine told me about it. When she told me about it, I put Anchorage Ponzi scheme in Google, and this guy's name popped up and caused me to send that email out to everybody in our group, because it doesn't just happen in Alaska. It probably happens in every state. People are looking for easy money, fast profit. And unfortunately, there's these con men out there that are taking people's money and having a wonderful life.
It's best to learn how to manage your own. That's what I say.
The best thing to do, that's what the IBD philosophy is, in my opinion, learn how to do it yourself. And if not, find somebody that maybe uses the IBD philosophy and has a trading business with experience and a good track record, some of the speakers on IBD Live have businesses like that, where if I can't figure it out for myself, maybe let someone like that manage my money. Oh, anybody else? I appreciate the comments. I've enjoyed the conversation. Anything else? Okay. I wish everyone a Merry Christmas, Happy Holidays, Happy New Year, all those things. Be safe out there. And I'll repeat what I said at the beginning because maybe everyone wasn't signed in. Yesterday, someone typed a question in and said, are we ever going to see another bull market? And I think Jason or someone answered and goes, yes, we'll see another bull market. It's coming. Just be patient. Sometimes it's hard to be patient, but watch your sell rules, watch your buy rules, have a fresh watch list, look at the big picture every day. God bless everybody. We'll see you. I'm going to sign off. Thank you very much. Appreciate the feedback and the comments I'm getting here in the chat window too. Thank you. Thanks, Frank. Thanks, Ron. I appreciate you guys for doing that. And we'll talk again in January.
Merry Christmas.
Thank you. Goodbye.